70% of all transactions in the marketplace are asset sales. Why? Well, the answer is simple. It's tax advantageous to the buyer. Buyers prefer asset sales for two reasons. One, they can get tax advantages. And number two, they can isolate the liabilities in your business they want to choose and leave the rest on the table. Everybody talks about the positives of asset sales, and there are generally plenty of positives. But in various cases, they can have some real negative consequences depending on whether you're an S Corp or a C Corp. If you're an S Corp, your tax consequences in an asset sale should be neutral, unless you've got assets that are significantly depreciated and there are depreciation recapture issues which could tax you at ordinary income tax rates. So if you do have depreciation recapture issues, your individual assets will be, like goodwill, will be taxed at capital gains rates, and your hard assets will be ordinary income tax. If you are a C Corp, there can be some serious tax consequences for you in an asset sale. I mean, it could depending on the state that you're in, you could easily pay between 50 to 70+% on an asset sale. So you're subject to a double tax. The first tax you'll pay when you sell your business itself, and you'll pay a corporate tax rate. And then when you take those assets and transfer them out of the C Corp, you will pay a capital gains tax rate. There's a couple ways to try to mitigate this risk or avoid it altogether. One is you could talk to your accountant about a 338 H10 election, or a 336E election, depending on your specific situation. However, if you are today have a C Corp and a sale is not on your immediate horizon, one of the things you can do is convert to an S Corp. Keep in mind that if you did convert to an S Corp, there is a 10-year built-in gains tax recognition period. So even as an S Corp, for 10 years, you could be subject to built-in gains taxes. The only time a C Corp asset sale is tax neutral is when, basically the purchase price of your assets is close to its cost basis and the goodwill is minimal. So I think it's very, very important that before you actually sell your business, to really sit down with your tax advisors and really look at what could be the tax consequences. I also suggest that you involve your M&A advisor, someone like myself, as a part of this, because there's too many gotcha factors that we as M&A advisors and exit planning advisors know, in addition to just simple tax consequences. There are purchase price allocations and off-balance sheet liabilities, etc., that may or may not be on the radar of your accountant. Rare Brain Capital helps companies improve performance and sell for maximum value. How ready is your company to grow or to sell? Want to know how you're doing? Get your free score plus customized report in just a few minutes at no cost or obligation. Visit rarebrain.com/score.